I'd like to welcome you very much to this afternoon's edition, which is on the topic toxic assets, bank losses, and the security of deposits. Would like to begin the event by calling on the Dean of the UPSA Law School to share some opening remarks with us. Please put your hands together for Professor Kofi Abochi.
Good afternoon, ladies and gentlemen. I would like to acknowledge all distinguished guests, especially our friends from the banking industry who are here today to speak to us on a topic that we find all too relevant. I don't say we find it all too relevant because in recent times we all know how our banking industry has undergone some changes, but some will argue the more things change, the more they remain the same. There was an allegation somewhere in the media that the stress test that was conducted by the Bank of Ghana does not appear to have yielded the dividend expected, and that when some of these banks were subjected to some rigorous examination, it does seem that they may not have passed the test even though they were subjected to these tests. Again, I'm saying rumor in the media because nobody's sure how true they are. However, one truth is that money fears uncertainty, and nobody wants to have his money kept by somebody, a group of people, an industrial set, without knowing exactly what is happening. I remember a few years ago, 2-3 years ago down the line, if I'm correct, when some of the banks went down under. Every day we all wake up and we check whether our banks were in the list. And if your bank wasn't in the list, you thank God. According to legend, some people died simply because they lost their money. While we were waiting for this event, I had a lively discussion with my friends. I'm talking about our distinguished speakers, our panelists today, about whether lawyers are worse than bankers. I think we all agreed in that discussion that bankers are worse than lawyers. But I'm sure they'll tell you a bit more once they have the platform. But yes, Gertrude, thank you very much for the opportunity of this conversation, which I think is extremely important. And I understand we have Mr. Johnny Wah, who's joining us, the Ghana Association of Bankers president, who's joining us virtually. So we've gathered a stellar cast of people who have expertise in the subject, who understand what they are talking about, and beyond the theory that we are taught in the classroom, I do hope that our students would pay careful attention and take notes about how toxic assets continue to endanger banks in Ghana, how banks are dealing with their non-performing loans and their other bad assets, and how the depositors' monies and funds with banks have the requisite security that is expected so that we do not worry and keep monies under our beds. So I would like to thank you, more especially, I have to mention that name again, well, FBN, the FBN Bank, the first bank of Nigeria, for sponsoring and taking up the tabs on this program. And not just that, but also delegating one of their most competent colleagues to represent them. The president himself, unfortunately, couldn't make it for good reason. The MD couldn't make it for good reason. And he's delegated one of the most astute personalities whom I've had a conversation with, and therefore I can testify to that. I would like to thank FBN for taking up the taps, and so do inform the president that I have thanked you. And what that means is that I would like to thank you again. So you would have to come back with your sponsorship again. So thank FBN, but I'd also like to thank our colleague from Bank of Africa. Yes, Bank of Africa, not Bank of Africa now. The Chief Risk Officer, who understands everything risk and who has had to trek here in spite of a difficult journey from Togo. So thank you very much for also making it. I would like to thank the President of the Ghana Association of Bankers, who's joining us virtually. And finally, I would like to thank our moderator, who has shown partiality towards banks, but I'm sure she will be extremely impartial, knowing who she is, and we're going to have a very good conversation this afternoon. So I'd like to thank you all, and let me also acknowledge my colleagues who are here, Naamedikwe, Ishak, and any other colleague who is here. I would like to acknowledge you. including you as well. So thank you very much, everyone, for coming.
Thank you very much, Professor Abochi. Yes, like Prof rightly said, this quarter's discussion has been made possible by FBN Bank Ghana. Please, let us show some love for FBN Bank. Yes. And at this point, we would like to take some remarks from a representative of the bank. Like Professor Abochi rightly noted, he's representing the MD and CEO of the bank itself, that's Mr. Victor Asante. And this gentleman is in the person of Mr. Alan Quay. He's the head of retail banking at FBN Bank Ghana. Please put your hands together for Mr. Alan Quay.
Okay, so I would kindly stand on the existing protocols duly established and just continue from there, because the essence of which we are here is the discussions. However, we are part and very proud, FBN is very proud to be part of this program. Why? Because it's a forum that enables us to share ideas, collaborate towards getting the industry being better in that regard, and also to ensure that at least our economy also grows in that light. The topic has given very relevant at this point in time. Yes, banks have gone through turbulent times as far as last year is concerned, but we have shown resilience in that matter to be able to come out of the lows to the highs. Our numbers we've shown on a quarterly basis have shown how strong we are as a bank. And of course, certain changes have happened also in the digital industry, working closely with our regulator, Bank of Ghana, to enable us achieve what we have achieved year to date. So yes, the industry is sound, and this is just a good platform where we can also speak to the young ones who are coming up to understand the industry better, and then to be reassured that no matter what, we are still strong as an industry. The bank has seen a lot, not the bank, but the industry itself has seen a lot of changes, some of which impact on digital transformation. We've seen a lot of fintechs come into our space, some very disruptive, but then we have all come to the realization that we cannot move on without having them as our collaborative partners. That is key. We've also seen an increase in fraud and cybercrime as well. Hits the industry. As they say, the bigger you become, the more risk you take as an industry, and of course the players in there. So we've seen a lot of fraud also happen. We've seen a lot of cyber attacks also happen. And as a bank, we have worked, or as an industry, we've worked collectively to ensure that these crimes are minimized. These fraud and cyber attacks are minimized to the barest possible. It cannot be fully eliminated because it's a risk, it comes with the industry. So we really need to prepare ourselves and ensure that we do this so that at least the depositors' funds stay intact. The banks do not get run down as a result of some fraud and things like that. So we have geared ourselves, a lot of certifications have happened among banks to be able to protect their banks, their customers from fraud and from cyber attacks. For us, lastly, I would say that this roundtable discussions are very meaningful. It's shown a challenge to the bank, FBN Bank, to sponsor again. We will look at it. We believe that it is worthwhile. It is fit for the industry. It brings us together. We can share ideas on how we can improve the industry. So for us, this is a clearly good opportunity that one would want to take. It's also in line with our corporate social responsibility of education and educating people and of course our partners in this regard. So let me say that we are happy to be here, and I'm sure that Akufa is also happy to be here. Our moderator is also happy to be here, and we are also here to make this event worthwhile. Thank you.
Oh, please, let's do it. Thank you so very much, Mr. Quay, and of course, thank you to FBN for being a good corporate citizen. Ghana appreciates the work that you do. I want to use the next 5 minutes or less to introduce the dignitaries that have joined us for the discussion here this afternoon. In fact, looking through the profiles, you can see that we have not only put together the best, but indeed the very best for this discussion. So let me start with one very remarkable woman. She's a C-suite banking and finance professional with over 18 years experience in the banking industry. Her expertise includes enterprise risk management, treasury management, strategy design and implementation, and financial markets trading. She's currently the Chief Risk Officer and a member of the Executive Committee of the Bank of Africa Ghana Limited. She's also an independent non-executive director who serves on the board of Guinness Ghana Brewers Limited, and she is the chairperson of the board of Savvy Securities Ghana Limited. She actually started her career with Unilever Ghana Limited, where she worked for a year in their production division. She then left to pursue a career in banking as part of the pioneer team of GT Bank Ghana Limited, when the bank was launched in 2005. She worked with GT Bank for 3 years in their treasury and risk management departments. She then joined the then amalgamated bank, now Bank of Africa, as the chief dealer in the treasury department, and was later promoted to head the treasury department of the bank. She has been credited with transforming the Treasury Department of the Bank of Africa into a key strategic business unit of the bank, and she contributed to the turnaround of the bank. She also has built a strong reputation for developing high-performance teams. Now to the interesting parts. She's a chartered accountant, ACCA UK, a chartered banker, CIB Ghana, a financial risk manager, FRM USA, and an ACI certified financial markets trader. She also holds an MBA in finance and risk management from the Business School in Netherlands, that's the BSN. She's a mentor to many young people, of course. Looking at the profile that I have just read, this comes as no surprise, especially young female executives who aspire to reach greater heights in the corporate world. She's also a member of the Executive Women Network Ghana, where she contributes to advocacy and support for women executives and entrepreneurs in Ghana. Please join me in welcoming Mrs. Akofa Dakwa. Right, now to our next speaker. Now, this gentleman is an experienced marketing professional with over 24 years working experience. His expertise covers roles at Unilever Ghana as branch manager, Standard Chartered Bank as head of sales, Fidelity Bank also as head of sales, Millicom Ghana as head of sales and distribution, Bank of Africa as head of retail. Oh, Akofa, did you know that? I see the link now. Okay. As head of retail banking and branch network, and GN Bank as general manager, marketing, sales, and customer service. In his new role at FBN Bank, he is responsible for driving the bank's retail agenda and delivering its propositions to its key segments, which includes a strong focus on the youth. He is also responsible for continuously maintaining the current momentum in the bank's drive to deliver a multiplicity of channels covering branches, digital and agent banking, all aimed at offering convenience, security, and excellent service to its customers and clients. He graduated from the University of Ghana with a degree in economics. He holds a postgraduate diploma in business administration from the Leicester University and marketing, as well as marketing from SEMA Ghana, and a master's certification in marketing from the University of Ghana Business School. Please put your hands together for Mr. Alan Quay, head of retail at FBN Bank. Right. Now I want to introduce to us our third speaker before I come to our moderator. Our third speaker is joining us online, like Prof. Abochi has already noted. Our third speaker has a proven executive management track record for over 2 decades, driving corporate growth programs across various functional areas in the financial services sector. He's the Chief Executive Officer of the Ghana Association of Banks, but before joining the GAB, he was managing partner of Jewa & Co. Advisors, which is a financial services consulting firm. He's a fellow of the Association of Chartered Certified Accountants UK and a member of the Institute of Chartered Accountants Ghana, ICAG, with several years post-qualification senior management experience. He holds a Bachelor of Commerce degree from the University of Cape Coast and an MBA from Oxford Brookes University, UK. He has previously worked with UMB as the CEO of the bank, and in prior careers, He has held senior leadership positions such as Finance Director at GCB Bank, Group Chief Finance Officer at EcoBank Capital, Financial Controller at Barclays Bank of Ghana, now UPSA, Chief Finance Officer at UBA Ghana, as well as Finance Business Partner at Standard Chartered Bank Ghana. He has a broad knowledge in investment banking, and he has been part of many landmark deals from his time at EcoBank Capital and as MD of UMB Bank. Ladies and gentlemen, joining us online is the CEO of the Ghana Association of Banks in the person of Mr. John Ewua. Thank you so much, Mr. Ewua, for joining us despite your very busy schedule. Now, I want to move on to our moderator for today. She's a consummate banking professional with over 18 years expertise garnered in various fields in the banking industry. Her range of managerial experience includes training, coaching, and resource management, retail banking, business corporate banking, sales and marketing, relationship management, payments, project management, banking operations, operational risk, AML, and compliance risk management. She's presently the Chief Compliance Officer of Societe Generale Ghana and a member of the Executive Committee. She has just completed a coursework for the award of a Master of Laws in Financial Markets Law and Regulation from the University of Ghana. She holds a master's degree in finance from the University of Leicester and a BA degree in geography from the University of Ghana. She's a chartered banker and a member of the Chartered Institute of Bankers Ghana. She's also a chartered marketer and a member of the Chartered Institute of Marketing UK. She's a certified anti-money laundering specialist and a certified global sanctions specialist, certified by ACAMS. Ladies and gentlemen, our moderator for today's discussion, whom I'll be handing over to shortly, is Abena Asare Minako. Please put your hands together for her. Thank you very much. So the discussion begins, and at this point, I want to hand over for our moderator to take charge.
Thank you so much, Gertrude, and welcome everyone to this August occasion. I'd like to say that our panelists today definitely have the right expertise and experience for this topic. And today we want to talk about the key topic being toxic assets, bank losses, and the security of deposits. And for lack of time, I want to go strictly and quickly into the conversation. As they say, ladies first, and as I say, ladies first. And so I'll go quickly to Mrs. Akofa Dakwa and ask her, really, are banks exposed to toxic assets? And how do toxic assets actually impact bank losses?
Thank you, Abna, for the question. Thank you, UPSA, for this invitation, for this very important discussion today. Yes, banks are exposed to toxic assets. First of all, I'd like to explain a bit what toxic assets are. So in a typical balance sheet of a bank or any institution, you have your assets, liabilities, and equity, which are the three main components. So the assets are the revenue drivers for the business, and that's translates into profitability. But we have the situation where these assets could become toxic and therefore not generate revenue for the organization or even result in some losses. Why would we say an asset has become toxic? Basically, an asset will become toxic where there's no market for it. So if you have any assets, like I have this pen, I should be able to sell it to someone at a good price. But where you have an asset, you can't sell it anymore, then that is toxic. Or the price at which people are offering for that asset, is ridiculously bad, then that's toxic. And this term originated from the 2008 financial crisis in the US. It became a global crisis actually, but it originated from the US, from the subprime mortgage crisis, where mortgages that were packaged as assets and sold to investors became very toxic when the housing market collapsed, and therefore banks made huge losses. Some banks went under as a result. In Ghana, I think we've had a similar situation with the DDE, where government's debt had to be restructured. Banks had invested heavily. About averagely 30% of banks' assets were invested in the in government bonds and bills, and that were impaired because of the DD. Basically, government couldn't afford to pay those high coupons anymore. They couldn't afford to pay parts of the principal, so principal had to be restructured for longer tenures. Interest had to be slashed from about 25 to 9%. Therefore, for assets on the balance sheet of banks, if those assets will no longer generate the right revenues expected, then you would have to impair the assets. Basically, what banks had to do was to present value the cash flows expected from these assets, and then take some impairment losses that hit the P&L of banks. I would also talk about bad loans, non-performing loans, as another type of toxic assets that banks have. So basically, how do these arise? Banks, like we were discussing at the lounge, we are financial intermediaries. We take deposits from customers and then on lend to sectors of the economy that need those funds. And if we give out those funds, but the general economic environment is not friendly, like we've experienced last year, this year as well, with high interest rates, high inflation rates. Basically, what that means is if businesses or individuals have to pay between 30 to 40% for to service their loans, they have to generate much more to be able to do that. And if they are not able to generate so much, then they can't repay their loans. Banks would have to restructure or even write off some of these loans, and that becomes very toxic assets on the balance sheet of banks. Meanwhile, we're financing these assets with customers' deposits, and for bankers, our word is our bond. We can't default, to our customers, and so we would have to take the hits. It impacts our capital and all of that. Yes, so banks are exposed to toxic assets, and these could lead to losses and really affect the financial system. Thank you.
Thank you. Thank you so much. I think that the audience has been very well educated in knowing what toxic assets really mean and the differences between when we talk about the loans and then the investment in government bonds and so on and so forth, and how it impacts at the books of the banks in terms of toxic assets. Gertrude mentioned that you are very experienced, and I think we can clearly see that. So thank you so much, Akofa. I would like to go straight to Mr. John Ewua. Knowing that the GAB had a lot to do, we saw all of that going on in the newspapers and all that. Knowing that the GAB had a lot to do with the DDEP, we would like to know what really are your thoughts based on who you are, being the president of the GAB. What are your thoughts on the overall role of the government in terms of borrowing in contributing to depressing asset quality of banks? In the context of the DDEP, for example, how has the impact been felt across the banking industry?
Thank you very much, Abina, and thank you to my fellow panelists and to our participants. I'm delighted to be here and to also contribute to this knowledge sharing. Your question has brought into sharp focus the impact of the domestic debt exchange program, what has now come to be known as the DDEP, on the banking industry in particular, and the country as well, generally. In the heat of the DDEP discussions, banks took the very difficult decision of focusing on how, as the banking community, we would contribute to be part of the solution of the economic distress that was staring us in the face. So while the industry is not asking for applause for the decision to participate in the DDEP, we would like the public to understand the crucial role that as banks we played in arriving at an IMF program for the country. The cost of that decision to the banking industry was 19.2 billion in new impairment, billion Ghana cedis in new impairments on financial instruments. And here financial instruments I'm referring to government bonds. And loss before tax of 7.4 billion Ghana cedis in 2022. And here I'm talking about 7.4 billion Ghana cedis for an industry that recorded a 7.6 billion Ghana cedis profit, all the way into a loss position of 7.4 billion in 2022, resulting in significant diminution in the capital levels of banks. I would like at this point to use the opportunity to address an issue that has received significant commentary from analysts and other watchers of the financial system, which is, so why did the banking system become so exposed to the government in bonds to the extent that one program and we are losing so much money? Here, if you look critically at the composition of the bonds, you find that some of the bond exposures captured under the DDEP were actually loans and advances which were subsequently metamorphosed into bonds. Included in the bond portfolio under the DDEP are what we all know as UPSA bonds, which originated from loans extended by the banks to the energy sector, and here in particular, the Volta River Authority, VRA, and loans to BDCs to fund losses that accrued due to the forex and the recovery during the years in the country where petroleum prices were not deregulated. So due to VRA and the BDC's inability to repay or service their loans, an arrangement was reached between the banking community and the government of Ghana to set up a special purpose vehicle to be called UPSA PLC, which then issued bonds to the banks to be repaid from the UPSA levy in the petroleum price buildup. So this resulted in the reclassification of these loans and advances to customers, or these exposures from loans and advances to customers to bonds or investment securities in the bank's financial statement. The other major item in the composition of the bonds portfolio is the Dutch bonds, which were also loans provided to contractors of the Ghana Education Trust Fund, GET Fund, who were not being paid by the fund. In response, the government set up the Dutch Trust PLC, which then issued bonds to the banks that had provided the funding to the contractors to settle these loans, to enable the fund to embark on new investments in educational infrastructure in the country, thereby converting these outstanding loans also into bonds. There are other bilateral government-related loans which were also settled with bonds instead of cash, as was enshrined in the loan facility contracts that the banks signed with the counterparties. Again, some of the government securities have underlying transactions in swaps or swap transactions that the banks had undertaken with Bank of Ghana and other transactions of similar nature. Finally, we should all not lose sight of the fact that in 2018, a new bank, Consolidated Bank, was set up and capitalized almost entirely with Government of Ghana bonds, thereby distorting the loan-to-deposit ratio of the banking industry and further increasing the industry's holdings in government securities. So from here, you understand that banks did not set out to unduly overexpose the industry to government, but there were intervening events that resulted in the size of the exposure that we have seen under the debt exchange program. So yes, the debt exchange introduced a lot of risk factors onto the balance sheet of banks. We had losses, our capitals went down, but we went in knowing that we're going to take on these shocks, knowing that our capital levels were going to go down. But there was a bigger call, which is a call to national duty and what as an industry we could do to support the economic recovery or the stability of the country and for the country to qualify for the IMF program. Thank you. Unless there are other aspects of my brief that you want me to clarify.
I think you've taken charge of that question, and I think that and I think that we've all been educated from our two previous panelists, Mr. Wua and Madam Akofa. We have learned that we lost 30% of our assets. We've learned today that 19.2 billion was impaired. And we've also learned that we lost, in terms of losses, that we had about 7.4 billion. Those are quite substantial figures, even for the entire industry. Now, today, from what you said, it's quite clear, it's quite obvious that we had some, challenges as an industry, as a country within the banking industry. There were some serious challenges. And this, obviously, from the figures I have just mentioned, which were pulled from you yourselves, impacted our financial positions severely. And this, obviously, is being put on the doorstep of the DDEP. Now, we are aware that, unaudited statements, I have to say, have been recently released for most of the banks, as per the regulators' requirements. These statements have been released. And Mr. Wua, back to you again. In your expert opinion, what would you diagnose the industry as, the status of the health of the industry relative to the financial statements that have been released today? As of today, of course.
Thank you very much. Given the level of the financial hits the industry recorded in 2022, personally, and I'm sure as watchers of the financial system, we should all be happy to some extent that the industry has started recording some growth and strong financial performance in 2023, as evidenced in the Q3 unaudited financial statement that the banks released in October. Just a little bit of statistics here. Total industry assets grew from 209 billion to about 250 billion in 2023, which is about 20% growth. And the other thing is total deposits, which to me is the test of whether confidence is coming back into the financial system. Deposits increased from 158 billion to 196 billion, which is significant and attests to the fact that yes, the financial system, experienced some hiccups, but gradually we are building back confidence and consumer trust within the banking system. And the banks have also recorded some decent profits as at Q3. While these are very positive developments, we should also be mindful that we have recorded some capital shortfalls that as an industry we have to recover by plowing back some of these profits and providing even additional capital, though the industry capital adequacy remains above the regulatory minimum. One other consideration that I would like to point out here is that as an industry, we have strong headwinds in the horizon, in the area of heightened impairments, which as at October was in excess of 18%. Impairment is a major concern because it is a lagging indicator on financial performance. So the risk we face today, as a result of where we find our country with subdued economic performance, businesses struggling, consumer confidence a bit low, inflation eating away purchasing power, all these have implications, but their impact may not materialize immediately as impairments today, but in the very near future. And that is why we should all be happy that the banks are gradually building back capital buffers through the financial performance that we have seen. And these capital buffers will be available in the event or the unlikely event that these headwinds crystallize and we record even significant or higher impairments than we have already seen by Q3. Finally, as to the health of the banking system, I think the best person to attest to it is the governor of the Bank of Ghana. And in the last MPC report, he was very clear. You all heard the governor when he said that, he stated quite clearly and emphatically that the banking sector remains stable, sound, liquid, and profitable, even as banks continue to adjust to the impact of the domestic debt exchange. So, Abena, to your question again, performance is good, but we are building buffers which have been eaten away as a result of the DDEP. We are excited, but we are not over the top, because these are more or less filling a hole that we dug as a result of our participation in the domestic debt exchange program. And as we speak, banks are still being asked to provide additional capital in spite of these profits that they are declaring, to inject additional capital to accelerate the pace of their capital build-up to the regulatory minimum, and also to record the buffers that are necessary to absorb any potential shocks that are in the horizon. Thank you.
Thank you. Thank you so much, Mr. Uwa. From what you are saying, it means that from the horse's own mouth, we are doing better, the banks are doing better, but there's a lot more to be done. Let me go to Mr. Alan Quay. I think you probably were thinking I've forgotten you. No, I'm bringing the most difficult question to you. I would like to know, and I'm sure our audience would be interested in knowing that from what Mr. Ewua has said, he's provided us some positives in terms of the figures and the statistics that we've recently seen in the financials. In your opinion, what has contributed? How has this position been achieved?
Okay, so thank you again to Johnny Wa for the statistics he has provided and the necessary background to be able to answer this question. Of course, my dear sister on my right has also provided some key statistics to enable us understand the industry very well. Yes, the banks have shown growth, have shown a lot of power to be able to come out from the year 2022, which was very distressful, very stressful, let me say, for many banks, based on the kind of investments they had made in government securities, only for it to be turned around and having to readjust. But our growth today, I would say, primarily can be looked at from two sources. First is the fact that the regulator has also changed its position to a large extent, introduced a few more prudential ratios the bank must look at to be able to do well as a bank. Then, of course, yes, I would also say internally, having suffered from what we went through in the year 2022, we've had to look at ourselves and see how best we can position ourselves to be more relevant and to be able to recover and make profits. Of course, for the banks, we've had to look at our corporate governance system and see how best we have improved it so that we don't find ourselves where we were in 2022. We've also looked at our credit management system. Obviously, that is also very key in it, or making sure that our assets are good, they don't become toxic, and then impact on our capital ratios. Let me say our stated capital for that matter. Then, of course, we have strengthened our sales and marketing as well, which means that we are no longer, we've been forced to go out, of course, with relevant products and services as well. There's been a lot of collaboration with the fintechs. As I did say earlier, the world has become more digitized than before, and therefore, if you want to be relevant and move with the tide and move with the needs of the banking market, you need to become more digitized. You need to offer convenience. You need to look at lowering your cost of banking. And who is the best partner to do that will be a fintech. Banks don't have the capacity. They are not as nimble as fintechs, and therefore, for you to be able to get along and to be able to recover and to make money, you must also partner with them. Initially, as I said, we saw them as very disruptive, but they were useful disruptions that needed to come to galvanize the whole industry for the benefit of the consuming banking industry. So it is worthwhile. Yes, we've also worked hard at minimizing the fraud. And of course, we've worked on our operational costs. We needed to show more a positive attitude to reducing our costs significantly. And therefore, we've had a few things that have had to impact on people. We've moved more into the digital space. We are no longer doing, we do a bit of brick and mortar, but a lot of it is now transferred onto a digital space. We've worked on on fraud. We've worked on reducing cyber attacks. There was at some point in time a lot of cloning in the system, check cloning. All of these are things that are costs that come to impact on our profitability and therefore our ability to grow and be able to support the banking industry. So yes, it's not by fluke that we have shown growth. It's as a result of the fact that yes, internally banks have taken certain key decisions that will drive their businesses forward, satisfy the needs of customers, and at the same time working closely with other partners, namely the fintechs, and of course working with our big brother, the regulator, in making sure that their monitoring and supervisions and inspections are up and proper, so that yes, we can face the incoming windfalls that John spoke about. So we are very positive about the future. It is necessary we needed to adapt. Other than that, we will die. Unfortunately, we have shown that we can adapt to the changing needs of the banking public, to the needs of the regulator as well, and also change to the needs of the investor and to the shareholders and to the community within which we operate. So, in short, it's a deliberate attempt that has led, deliberate decisions, policies, actions that have led us to the situation where we are able to recover and be able to push forward into the future.
If you are listening in or watching us and you did not take that as a free consultancy, I'm not exactly sure what you are listening to us for. I have noted everything, and I'm going to take that into a free class. I'm going to assume that was a free class in strategy in terms of how to move on from your bank losses. On that note, Mr. Wua, I'd like to, stemming from what Mr. Quay said, he mentioned working with the regulator quite clearly. He said a lot of collaboration has happened with the regulator. And from where you sit, I know that you do a lot of discussions. You represent the banks as an association. You act basically as an intermediary between the banks and the regulator. What really, in your experience, have been the models and the impact of government and regulatory policy in achieving the position that you yourself just talked about? What help has the government or the regulator given? Unfortunately, we can't hear you, Mr.
Yeah.
Yes.
Can you hear me now?
Yes, much better.
Yes. Of course, it would have been extremely difficult for the banking industry to respond the way we have, also to weather the storm and the heavy storms that the DDEP introduced. Had it not been for the intervention of the industry regulator, Bank of Ghana, who, following the stress test we conducted, decided to work with the association to introduce some regulatory reliefs to the banks to enable us to operate seamlessly, or to transition from an era without DDEP into an era where our earnings have been suppressed from 25 or 21% to 9% on the bonds. So the regulator introduced some reliefs, some of which I would like to run through so we know exactly what helped us to weather the storm. First, the cash reserve requirement was reduced from 14% to 12% in cedis, and also the cash reserve requirement, which we used to keep for foreign currency, a cash reserve requirement on foreign currency deposits in cedis. The regulator changed that approach and said, you know what, if you take deposits in cedis, reserve in cedis, if you take in, let's say, dollars, reserve in dollars, which technically released a lot of cedis back to the banks because we were covering the foreign currency deposits with CD reserves. So that was a very positive intervention from the regulatory standpoint. They also reduced the capital, or almost eliminated, actually, the capital conservation buffer. The capital adequacy regulatory limit is 10%, and then there's a prudential buffer of 3%, making it 13%. In order to help the banks go through this difficult period, the capital conservation buffer, which was the 3% on top of the 10, was removed, which brought the capital adequacy ratio technically to 10%, which meant a lot of the banks were able to meet the capital adequacy ratio. Again, the new bonds that were issued under the debt exchange program were allowed for as deduction in determining the financial exposure of banks to counterparties as captured under Section 62(8) of the Banks Especially Allowed Deposit Taking Act 2016 Act 930. Again, the risk weightings that were attached to the new bonds were set to 0, just like we used to enjoy when they were called government bonds before the domestic debt exchange. Again, the regulator increased the Tier 1 component of regulatory capital from 2% to 3% of total risk-weighted assets. I'm talking about the Tier 2 component of the risk of the capital build-up from 2% of risk-weighted assets to 3% of risk-weighted assets. So in this case, what this does is, if you are a bank and you have a lot of capital which is classified as Tier 2, and for which you are restricted on how much you could add as part of your capital adequacy, the regulator said you can now move it from 2% to 3%, which was a very positive development for the banking industry. And finally, we also witnessed a relief in the area of an allowance for the portion of revaluation gains which could down move as Tier 2, also increased from 50% to 60%. And finally, the losses that we recorded, the regulator said, we know these losses are going to cause capital shortfalls, and that will give you a max up to 3 years for you to work your way back into regulatory conformance. So the banks have up to 3 years to make up with the capital shortfalls. Of course, the regulator advises banks to front load the capital so that you don't wait until the end of the third year to bring in the capital, but as we move on, you inject capital as needed. So at the time of the DDP, if you all remember, the government also said we're going to set up a Ghana Financial Stability Fund, which unfortunately could not come into being when we were signing on to the domestic debt exchange. But the good news is the Financial Stability Fund has now been set up. The investment committee is now working. They've received some applications from banks that have need for either liquidity assistance or solvency assistance, and work is currently ongoing. And those who have been monitoring the banking environment, you would have seen that the Ministry of Finance published the framework of the Financial Stability Fund, describing the various levels of funding that is available and the qualifying criteria for the banks that would like to participate in this. So clearly, yes, it has come a little late, but better late than never. So the combination of the two, the regulatory reliefs that we saw from the Bank of Ghana and the Financial Stability Fund establishment, have helped in a way for the banks to weather the storm. I would like to just highlight here that some of the reliefs that we had, the regulator, of course, the letter that we received said the reliefs will be reviewed in the course of time, and as and when they believe that they have served their purpose, the reliefs will be taken back. And already you have seen some of the reliefs being taken back. The first one is the cash reserve requirement has now even increased further from where it was from 4 to the 14. It is now 15%. And the requirement to reserve currency for cash reserve requirement has also been removed. So we now have a unified cash reserve requirement. We don't have a unified cash reserve requirement anymore. If you have cedis, you reserve in cedis. If you have dollars, you reserve the dollar component also in cedis, which is further taking a lot of liquidity away from the banking system. Of course, we all know that the Bank of Ghana is seriously tackling the risk factors associated with inflation, and we believe these are some of the tools that, monetary policy tools that they have at their disposal towards fighting the menace caused by inflation. Thank you.
Thank you so much, Mr. Wilder. And obviously, the regulator has put in effort to support the industry, even though for Mr. Wu's submission, there is some rollback going on, but definitely there has been some support and well appreciated support from the regulator. Let me go back to Madam Akofo-Adakwa. Madam, regarding bank assets and non-performing loans, which I know is a topic that risk professionals like to bandy about. What would you say is the trend in the past year for the banking industry? What are we looking at in terms of the bank assets, the non-performing loans? And apart from that, we always talk about non-performing loans. We talk about government bonds, so on and so forth. Mr. Wa was talking about ESLA, Dache, and so on and so forth. But what other variables really impact bank losses?
Thank you, Abna. I think Mr. Wa has helped us with a lot of the statistics already. So generally, from October last year to October this year, banks' non-performing loans have increased from about 14% to currently to about 20%, according to figures from the central bank. This is a very remarkable 6 percentage points, and just shows the stress that bank assets are going through at the moment. And I already talked about the variables that are affecting these NPLs, the general unfavorable macroeconomic conditions, high interest rates, high inflation, which affects the purchasing power of individuals and businesses, and therefore impacts business revenues and their ability to repay their loans, etc. We also have a very high exchange depreciation rates. Last year, depreciation was over 50%. This year, it's about 25%, and trending upwards in the month of December. All of these impacts the ability of businesses to make revenues. We are heavily import-dependent country. A lot of the businesses import raw materials for their production, and so with a 24% depreciation, you have to cough up more cedis to import the same level of raw materials that you were importing last year. And so this has impacted the NPLs of banks. Banks have to restructure some of these facilities, therefore delaying the receivables a bit longer, or even have to write off some of these loans, thereby impacting our capital positions, our profitability, and the like. Another thing that is affecting the profitability of banks or leading to some losses is the fact that banks are holding these toxic assets on our balance sheets. We have bonds running at 9% coupon. Meanwhile, Treasury bill rates currently are trending at over 30%, and this drives deposit rates. So if you are only earning 9% for a part of your assets and customers are demanding equivalent T-bill rates for their deposits, how do you manage? It means that, and these assets, you can't sell them, they are toxic. So you have to keep them on your balance sheet for 10 years, up to 15 years. How do you make profits out of this? So that is also a source of losses for banks. Mr. Kwe has already talked about operational losses, cyber crimes, and others. We also have customers who deliberately come for loans with no intention to pay, further deepening the woes of banks and the like. And so these generally have impacted banks. Mr. Wa, I won't bore you with the figures again. Mr. Wa has talked about the payment losses that banks have had to take since last year, the overall after-tax losses that the banking industry made last year. So briefly, these are some of the sources of losses for banks.
Quite alarming. But Mr. Alan Kwe, please, in light of all this, let's get to the crux of the matter. How secured are deposits? in view of all these trends, all these developments, all these statistics that have been indicated, how really secured our deposits. And when we look at the statistics yet again, we see that there have been reported decreases in the industry average or the capital adequacy ratio, for example. And is this going to impact the security of our deposits?
Okay, so for the audience, I would just want to define in simple terms what the CAR is, which is the capital adequacy ratio. It's simply a measure of a bank's financial strength. And ratios are ratios. Where the ratio is high, it means that the chance or likelihood of that bank suffering or failing in future is low. And when the ratio is low, it means that the chances of the bank failing in the future is high. So it's important that we understand what the capital adequacy ratio is. It also means that as I said, measures your financial strength to be able to meet due liabilities. And when we talk due liabilities, we are talking about depositors' funds. As and when they come for it, we being able to give it to them. It also measures to some extent your liquidity as a bank. If you are not able to meet depositors' requests, as in they want their money, then it creates further problems. Okay. Now, what it also means is how strong are you to absorb some losses that come your way. We also, as an entity, do sometimes make losses, and we've seen it in not just in 2022, but in other years. A few banks have declared losses, but not losses that made them become, that had to go down completely, but they were able to absorb the losses and still recover and still bounce back and be able and become very stronger banks than before. So it is important that we understand the capital adequacy ratio. Now, one factor that hits the capital adequacy ratio is what Akofa said earlier on, that we fund our risk assets from depositors' funds. And we must be able to fund these risk assets with the mindset that, or with the expectation that what we've projected in terms of revenue do happen. If they do happen, we are good to go. If it doesn't happen, then it means that it affects the capital adequacy ratio, and that is not good. So it's important that, yes, as we take depositors' funds, we safeguard them, make sure we give them to the right people who can rightly pay. We can give them to government and ensure that they do pay. But unfortunately, yes, what we expected from 21 to 9% would give us cause to think whether it's worth our while to still put money in government securities. We'll do all the necessary checks and be sure that what hit us in 2022 doesn't happen. Then, of course, yes, we do some placements with our fellow banks as well. We did suffer from such as well, because when these other banks went down, it meant that those funds that were with us were not available. So obviously, as you place deposited funds in such situations where you are not getting the required returns, it impacts very much on our capital, stated capital, and that has its own implications, because then it means that customer confidence goes down, investor confidence goes down. There is some liquidity squeeze, which means that there isn't enough money to support those who want money to grow their businesses and also for their personal needs. If it's that bad as it did happen with some banks that were closed, then it means government must now find needed money and to support those banks, which means that money that could have been used for other public good, maybe roads, streets, or other things are diverted to support the banks or to pay the customers in that regard. So 25 billion was spent when a couple of banks were closed down to as much as 25 billion. You can imagine what that 25 billion could have done for the economy. Okay, so it is, as it stands now, our CAR has been increased to 13%. John earlier on said it was 10 with some buffer, but now currently is at 13. The numbers that we have seen so far, even though it has declined for banks, is still above the 13%. So for me, it is still a healthy sign. Yes, it's declined, but we are not at the 13% yet, and I don't think we would we would go below the 13%. So for customers, yes, it shows that your deposits are safe with us. For investors who also give us money as banks, yes, your funds are safe. And of course, like I already said, based on learnings we've had from 2022, our corporate governance structures have improved. Our credit management processes or framework has also improved. We'll continue to drive relevant products. We'll continue to drive leads, work closely with our fintechs in that regard, all to ensure that we make money, we make good money, we can apply it back into our capital to make us stronger so we can lend to the economy, we can lend so that the economy can grow for that matter. A lot depends on customer confidence. And so when the customer is very much confident in the banking industry, they are willing to put their money there. I'm sure you may have heard that there were some people who want to have their own safes now. They keep their funds at home. They don't want to bring it to the bank. They don't want to go through what happened to them some years ago. Fortunately, we won't get there. I don't think we would ever get there again. And so, yes, the depositors' funds are safe. The ratios show that we're above the industry and we'll work towards improving our numbers as far as CAR is concerned, above the 13%, which will be a clear indication that we are strong and we can meet customer requests as and when they ask for it. And that has been the trend so far. This year, we haven't seen any bank in that regard suffer from liquidity challenge. We work closely with ourselves as well. As we said, we borrow as and when demand goes above a certain levels and we don't have it, we borrow from another bank, knowing very well that we would replace it per the agreements we have. So we are very sound, and for customers, I can say that your depositors are safe as gold for that matter. Thank you.
Thank you. I see Mr. Uwa nodding his head, which means you have full confirmation of the GAB that
once the president of the GAB, yes, who is more or less the overall CEO that sees how all the banks are operating, notes and said it's a clear indication that we are safe.
We are safe. The banking industry is safe, according to Mr. Quay and by extension, Mr. Uwa. Akofa, please allow me to come back to you. With your experience, and I'm very much interested in the risk profile, what traditional and again innovative ways can banks as in general, engage in to promote asset quality and definitely reduce the NPL rates in Ghana today? Even as an extension of this question, how would banks continue to act as intermediaries, protect the industry from exposure to excessive risk, basically, and ensure that depositors' interests, just as Mr. Quay has already mentioned, are held paramount within the scope of the industry?
Thank you, Abna. Yes, so I'll take it from the last section of your question. How will banks continue to act as intermediaries? That is our job. So we will continue to act as intermediaries in the financial ecosystem, take deposits from customers, keep them safe, turn it around, so that other sectors of the economy that need these funds for development would have access to it. But how do we promote asset quality and reduce NPLs in Ghana? First of all, I think Mr. Quay touched a bit on this when he said we have post-DDEP, we have really looked at our operations. So in like manner, as risk managers, we've really looked at our risk appetite for the various segments of the economy that we play in, the various products that we deal in. So banks would usually rank assets that we invest in terms of which one is risky, which one is less risky, which one is just in the middle, and the like. But then as the macroeconomic indicators change, as the environment changes, we have to relook at these risk appetite as risks crystallize. So a risk that has crystallized is the domestic debt exchange. Bonds have been restructured. In the history of Ghana, we hadn't seen domestic bonds being restructured before. So most banks thought this couldn't happen. External debts have been restructured, but not domestic bonds. So we thought this couldn't happen. We had comfortably ranked government bonds and bills as risk-free. Now we are having to rethink this definition of the risk-free definition of government bonds. And then we look at our asset portfolios in totality and risk rate them. So definitely now we won't put government securities as risk-free anymore. We would, in like manner as we look at the various segments of the economy, we have various concentration ratios for playing the various sectors of the economy. So even though government securities would have less risk than other sectors of the economy, we wouldn't want to be so over concentrated, in government securities. Mr. Iwa has already explained to us how banks got into a lot of these bonds somewhere and not voluntary. You had to support the government in clearing some of these debts, energy sector debts, debts to contractors, and the like. So, to promote asset quality, banks have started and will continue to research into the various sectors of the economy, look at the sectors that have been adversely impacted, design appropriate products, controls to safeguard the funds that we put in these various sectors. We look at our concentration ratios and make sure we are well diversified so that we are not adversely impacted from just one sector of the economy. In like manner as well, I already talked about research, and that will help us to build models, to give both insight into the potential risks that we would face as banks, and then some foresight into risks that are in the horizon as well, and build databases and historical trends that would help us foretell what could happen in future. So I already talked about the fact that we didn't have a history of domestic debt defaults in Ghana. However, there had been historical evidence that other countries had faced these issues in the past. If proper research was done, databases were built that could have pointed us to the fact that this could happen, and therefore we needed to take steps to probably reduce the concentrations in these sectors. So that as well, I would also highlight on capital planning and scenario analysis. So banks continue to analyze various scenarios of what could happen and build capital buffers so that we are quite resilient to weather any storms that would arise. Finally, I'll touch on building a good or strong risk culture within our institutions. As the front liners, usually they take the risk and they probably understand the risks better. So risk managers would have to work very closely with all staff in the institution, especially the frontliners, to continue to identify the risks and continue to put in place controls as the environment changes to make sure that we safeguard ourselves from those risks crystallizing.
Thank you so much, Akofa. From what you're saying and from what Mr. Quay mentioned before, I see the clear point of diversification, especially as one of the key components of moving forward. I want to just say that we do have this discussion live on our Facebook page, the UPSA Law School Facebook page. This is live on. Mr. Quay, do you want to add on to what?
Yes, I would want to. Akofa spoke a lot, and indeed, but I just want to add a few things, so which reflects more or less banks' decisions and policies and goals. We've had to look at our loan to deposit ratio again, because that determines how much you want to take customers' deposits and use to support risk assets. So we've had to look at those ratios again. Banks have also gone on a serious recovery drive, even though it's been very tough. It takes longer to recover, but at the end of the day, you do get something rather than nothing at all. So banks have strengthened or improved their recoveries with regard to those who are owing the banks, more especially not on the government side, but more of the individuals and entities who have borrowed from us. As he clearly said, one function, some people actually borrow and with the mindset that they will need. Some too would say, because you did not support me with further funds, I will not pay the loan. And so we've had to be very hard to be able to recover such funds from such defaulters. We've also gone into restructuring of some facilities or risk assets. These are ones that have shown the potential to pay, but maybe because of one or two valid reasons they've not been able to pay. A function of which is always the macroeconomics indicators of the country. If the country, the dynamics are good, you find that people are able to borrow, the lending rates drop, people can borrow, work hard and pay you back what you want. But in the regime where interest rates are high, it makes it pretty difficult. But that notwithstanding, those who have shown the ability to stand the macroeconomics indicators, the banks are willing to restructure, give them longer tenures so the repayments are much more affordable and therefore does not become NPL. We've also worked closely with our sister, with the partners in the industry. I'm talking of other banks, working with other banks in that regard, so that at least we keep the industry healthy, which is good for everyone. Because what happens is if one bank goes down, rumors then begin to run riot, and then you see some other effect hit some other banks. Sometimes it goes even beyond the local situation to international banks, because sometimes our lending or our support goes to outside the country as well, of course, with the permission of Bank of Ghana. So those are things that we need to collaborate more within ourselves to safeguard the industry and in essence safeguard depositors' funds as well. So these are things I just wanted to add to what Madam Akufa has spoken about. Thank you.
Thank you so much. Very insightful. I'll take my last question with Mr. Uwa. Mr. Uwa, a lot of conversation, a lot of talk has happened today regarding asset quality and of course NPLs. And Mr. Quaid just mentioned loan recoveries. I'm interested in knowing, and I'm sure our audience is as well, is that, and being that we are with the UPSA and we are in the law school, how useful has a legal system been towards loan recovery for the industry? What are the challenges and what can be done such that our learned friends can support us in this direction?
Yeah, thank you very much, Abina. Unfortunately, I'm not a lawyer, so I'll attempt at using my own experiences.
Yes, which is fine.
And the fact that I've been around for a while, so I know exactly what the legal system has done to the banking system in terms of loan recovery. Our legal system, with all its loopholes at the moment, as presently constituted, basically presents a scenario of a borrower's legal system with little or no assistance as enabler for banks' recovery efforts. We are all witnesses to how our lawyers, Prof. and his team, have been frustrating the lending institutions when we attempt using the court system for our recovery. And as I said, though I'm not a lawyer, there are a few things which we have already highlighted to the new Chief Justice, her Ladyship Justice Tokome. We are very much concerned because we need an efficient legal system to fast track our recovery. Once we are able to recover the loans that we have given, which are now distressed, we then are capacitized to give more. The more banks are locked up in legal litigation because the court system is not facilitating recovery, the less liquidity that the banking system will have to lend to those who are willing and able to pay. Clearly, and as an example, we have lapses in the administrative operations of the registry's office and the service of processes that we have highlighted to the court, basically to the Chief Justice. The hesitation of some judges in strictly applying the rules relating to summary judgments, the hesitation of some judges in applying the rules relating to enforcement actions as provided by our own laws, the Borrowers and Lenders Act 2020 at 1052. The courts have also continued entertaining repeat applications for stay of execution so to enable the borrower pay by installment, even when there is ample evidence that the debtor does not have any intention to make any payment, but the bank is now forced to go into an arrangement to get this person, give them some time to make payment. Sometimes the refusal of the courts to award punitive damages against loan defaulters for filing frivolous applications and frequent adjournment of cases at the insistence of loan defaulters who are defendants in the cases that we have in the courts. Again, non-appreciation of the processes pursued at the collateral registry by banks often lead defaulters to resort to commencing actions against banks here and there in the court when the collateral registry process has been invoked to realize the securities upon default of the debtor. The courts, unfortunately, tend to stay the outcome of the processes undertaken at the collateral registry pending the outcome of the rates filed by the defaulters. These actions unduly delay any recovery efforts initiated by the affected banks. And in some instances that we have seen in the past, some courts fixed reserve prices, above the for sale value of the collateral. It's clearly stated in the valuation report which was presented in to the court. Meanwhile, the reserve price is fixed above this. The borrowers then will refuse if they are unable to auction the property, and they will come back to the court, a new reserve price, and all this back and forth results sometimes by the time judgment is received or you are able to enter execution of the judgment, the subject, for the collateral is either destroyed, it's sometimes stolen, sometimes worthless, and it doesn't help. And I'll give you a clear case here. In the 2008 financial crisis, in America, overnight, within a matter of days, the number of mortgage properties that were put on the market for sale, foreclosed, it was amazing. In Ghana, we can only dream about that. There will be self-processes here and there. A wife will throw in the document saying my husband did not receive my consent before using the property as collateral. And all these things come in to frustrate our ability to recover. But here I'm happy that we have a new Chief Justice who has committed to doing something about it and to helping the banking system to facilitate our processes within the court system so that we can fast-track our pace to recovery when the need arises. And it's not just the court system. We have the Office of the Registrar General, where ventures and co are also enforced. We have the problems we continuously also experience with Lands Commission. We all are witnesses to that. So we have pockets of institutional structures that together must work efficiently if we want to deepen financial intermediation. And finally, to those who are listening or watching us, I would like to say this. If banks are able to go to the court when there is distress in the facility and recover quickly, it has a way of filtering back into the cost of borrowing. So the banks are now pricing in the inefficiencies within the court system within the interest rates. So people who are legitimate borrowers who have credible history, all of a sudden are being made to pay for the price of the people we as lawyers are facilitating to frustrate the recovery processes. So here we will advise our friends who, by God's grace and their own intelligence, have become lawyers that, please, if you are defending a borrower, we are not saying they need no defense. Yes, they have to defend their rights. But please, any attempt at intentionally frustrating a bank's ability to recover, you are not hurting just the bank. You are hurting the stability of the country. And you should be mindful when such actions or your clients are asking you to undertake certain actions just to delay processes in order for them to circumvent your indebtedness. And thank you very much, Abuna. I think it's a very good thing that you have asked me this question, because I'm very passionate when it comes to the work that the courts are doing, and the fact that it has significant negative impact on a bank's recovery efforts. Thank you.
Thank you so much, Mr. Uwa. I think it's very clear that we have poked a little sore of Mr. Uwa, if I may translate from Tree directly. And I think that he has said it clearly what the needs of the industry are in relation to making sure that in terms of the NPLs, the loan recoveries, the toxic assets that we have just talked about, how to make sure that we improve them. This is a very clear case of making sure that the court systems are, duly, work quite well towards making sure that the banks recover the funds that have been, given out. But he also did mention that we do have the support of the Chief Justice, which is very appreciated. And but of course, there's a lot more to do. I would like to give a disclaimer to myself and my colleagues that we would have to walk straight out of this room, and therefore the lawyers in the room. Mr. Uwa has made his comments, and we disassociate from the comments in order to get out of this room. So, Gertrude, I don't know if we have time for questions.
Maybe just two.
Okay. So, well, on my side, I think that questions have been answered at the key points in terms of what toxic assets are, the contribution to bank losses, and the safety of deposits have been clearly stated. We have seen some conversations regarding what strategies, especially the banks have put in place to move ahead and gotten the figures that have been gotten. Also, conversations have happened in relation to what the next steps are in terms of risk management and controls, and where we want to go as an industry towards ensuring that what has been achieved is maintained and more is done. Especially the fact that one key point that I got was the fact that, yes, the regulator has contributed in terms of providing some reliefs. However, we haven't gotten to the end of the road yet, because some of those reliefs are definitely going to be rolled back as and when the regulator believes that the industry has become a lot more stable relative to what we went through in 2022. I'd like to say a very, very, very big thank you to my panelists, Madam Akofa Dakwa, Mr. Allen Kwe, and also my GAB President, Mr. John Ewua. Thank you so much, and I'll hand over to Gertrude at this point.
Right, thank you. Please, let's put our hands together for our panelists. So for want of time, we'll just take one round of questions. If you have a question, please raise your hand. Okay, 1, 2, any other? 3, 4, 5. Okay, that's it. So please be precise and concise and just go straight to the point so that we don't end up spending too much time here. So let's start from here.
Okay, my question is in relation to whether you are really facing competition with the mobile network. Because I've kind of seen that they are more or less becoming more of banks rather than telecommunication companies, especially MTN, in view of the amount of money they actually collect from people. My question is, do you face the same regulations, or do you sometimes feel you are being unfairly regulated instead of this network properly termed as mini banks or whatever name they call them? But what I've seen is that because of the development of technology, there was a similar situation like 10, 20 years ago. You see how Western Union, money transfer, MoneyGram, it's like they were sleeping. All of a sudden, they are caught unaware by Unity Link and Co., who are now even much bigger and much faster in sending money. Are you and the network facing similar problems?
Okay, thank you very much. My name is Chunibu Akudia. I'm a level 400 student. We want to commend the banking sector and to say that the enhanced risk management, corporate governance, and the innovation that we are seeing is something that is very good. And let's all do our best to support it, especially those of us who take loans and we decide not to pay. Because if you don't pay, you are creating more risk and also increasing the expense. My question is, as Mr. Ewua mentioned, that one of the things that the central bank did to help with institutions was the issue of keeping reserves in their respective currencies. If I got that. Now at the last MPC meeting, the central bank announced, specifically note 28, that there's a reintroduction of the unified cash reserve, which means that those cash in deposits in foreign currency and CD are all to be kept in CD. What is the effect of this reversal of this relief the central bank gave? And my last point is on the issue of our economy now. We went to DDP knowing, because interest rates were very high on these investments, i.e. government bonds, and we had to now take a haircut to 9%. Now Treasury bill is above 30%, even higher than what led us to DDP. Are we going back to DDP? Thank you.
Yeah, thank you. Should we take all the rounds or do you want to address? Okay, right.
So I think I'll hand this over to the first question to Mr. Quay. The competition from the telcos. What are the comments you have on that?
So, Bank of Ghana regulator wants to achieve a cash-light economy, and to achieve that, it means that money being digitized is one of the ways by which it can be achieved. Of course, you could use cards, you could use POS, among others. POS is point of sale as well. So in their quest to achieve that, yes, and it's also very important for the banks because once it's also cash light, the risk is also reduced. You've heard of all the bank robberies, attacks on bullion van, which today has necessitated that all banks now need to get or rent a bullion van. To buy one is also very expensive. To rent is equally expensive. So if the economy was more cash light, where we use very little cash to make payments for goods and services, and it's all electronic, then there will be no attraction for attacks on banks, attacks on bullion vans in that regard. What it would then lead is cyber fraud, where people try to get into your system and use other electronic means by which they can take your money. So the objective is very great. It has its plus and minuses. The regulation here is what has facilitated the growth of mobile money in Ghana. Elsewhere in Nigeria, it is not the same. So yes, the mobile money companies, MTN for that matter, yes, they are more like banks in quotes, just that they don't do certain things that other banks would do. But then there's also, let's also note that apart from the mobile money companies, there's also the fintechs who have found very innovative ways by which they will compete with us, but also collaborate with us in certain areas as well. In the past, it was quite difficult to transfer money out, isn't it? You needed to go to the bank and do this. These days, you can use your card, you can use through a fintech, transfer money from anywhere. Again, the same using technology. All these, what do you call them, money transfer companies, the MoneyGram, the MoneyGram and Co. You needed to walk into a branch to cash out, isn't it? Now they are moving straight into your wallet. It means that the risk or the time spent in coming to the bank, the convenience is created, and therefore straight it hits your account and you don't need to go to the bank. So these are useful disruptions. As a bank, we need to innovate. And many of us have gone into some collaboration with MTN so that we can also play actively, make some good returns, even though we don't bring our face to the fore. For instance, they do a lot of micro lending, isn't it? Some people want just 30 CDs, some want as much as 500 CDs, which a bank would not do, okay, instantly. But through the mobile money, because they have the logarithms and they have the infrastructure, they can evaluate a request for 30 CDs in quick time based on how much airtime you buy, and they know that, look, you will qualify for a 30 CDs loan, you will qualify for a 500 CDs loan. But as a bank, what do? I can provide that money and partner with MTN to fund that kind of micro lending and still make some good money as well. The beauty of such is also the fact that the NPLs are pretty low. So I can put some good 30, 40 million or even more, 100 million to some schemes, and I will still make a good returns, and I will not suffer NPLs, which would again come to impact me on the capital adequacy ratio or my stated capital. So yes, it's good, yes, it's bad, but bottom line is, I think, the way the economy is going, the way the whole economy is becoming more digitized, we need to be able, as banks, to play a part in it in whichever way we want it. We need to be more innovative anyway. We need to go into more partnerships, more collaborations, so we can still be relevant to our space. Of course, the telcos have their space, but they don't satisfy everything. So there is some unmet banking needs that banks still are required, that banks can fill by providing the relevant products and services in that regard. So it's good for us, I would say so. It's good that we collaborate in that regard.
Thank you. And I guess just to add on, as a moderator, the benefit is always to the customer, isn't it? Despite the competition that we might feel as the banking industry, the benefit always in terms of competition is to the beneficiary, the customer. So I don't know if Akofa would like to take the second question, which had to do with the impact of going back to the unified cash reserves situation we have. Yeah, if you would like.
I'll take that. So basically, the regulator took this decision to control inflation, to mop up excess liquidity in the banking system. So from the September figures published by banks for total deposits and computing this increase in cash reserve requirements, the regulator has been able to mop up some 9 billion CDs from the banking system by increasing these cash reserve ratios. Basically, the impact of this on banks is an increase in our cost. So where we were keeping the reserves in the various currencies, if someone brings you dollar deposits, you reserve 12% of it. Now you have to reserve 15% of it in CD equivalent. We all know that dollar cost is much lower than CD cost. So it costs you, let's say, averagely 5% to borrow on the interbank market for dollar. However, for CD, it costs you about 29% to borrow. So that's a 24% spread. Banks will now have to, if they don't have their own liquidity, have to borrow this 15% of all foreign currency deposits from the interbank market at 29%. That's an increase in their cost, which obviously will be translated to the customer eventually in terms of probably increase in lending rates and the like, and that impacts costs in the entire banking industry. So that's what I would say about the cash reserve ratio.
Thank you. Thank you so much.
And then he asks another question, are we going back to DDP? Yes. no, we are not going back to DDP, hopefully. So we all know that part of the impact of the DDP government debts were considered unsustainable, so the capital market were closed to the government. We couldn't borrow on the international capital markets anymore. So government has to look inwards and borrow from the domestic T-bill market. The bond market is also not functional at the moment, so T-bill is the only source of funds available for government to meet its deficit requirement. And basically, the treasury bill market is, how would I put it? It's a demand and supply situation, okay? So the more government demands a lot of funds from the T-bill market, which we have seen auction by auction, government targets keep increasing. Then investors also ask for more. And then investors are also looking at getting some reasonable return. So if inflation was at 54%, has dropped to about 35. Today we heard inflation has dropped to 26, but averagely throughout the year was about 40%. So investors needed a real return on their investment. So they kept pushing the demand for higher yields on the T-bill market, and that's what has resulted in the high T-bill rates that we have. Are we going back to the DDP? I don't think so. Government still has the external debt restructuring to complete. That would also bring some about $10.5 billion relief. That is the target by the government. If that comes in, that will release a lot of pressure from the government. They wouldn't need to borrow so much from the domestic T-bill market, and therefore, hopefully, the rate will reduce. And as inflation also reduces, today we are 26%, and the target we've seen is to end the year at about 29. Some analysts have also predicted 27%. If that happens, T-bill rate will definitely fall in tandem, so that government doesn't pay so much interest for its borrowers, and we don't go back to the DDP. Thank you.
From your mouth to God's ears, I guess. Amen.
Okay, we have some two more. So yeah.
Okay, my name is Edem Kondobre, University of Cape Coast, a finance student. Please, we've been hearing about the collapse of some banking institutions. I would like to know, as individuals, the factors to consider in choosing the best banks so we don't fall vulnerable to.
Thank you very much. From the deliberations here, we've got to understand, I stand corrected, that the main focus for all these measures is to ensure the stability of the financial sector. My question therefore is, have there been any best practices or lessons we have learned from nations that have been able to deal with these similar banking crises and have implemented these deposit protection schemes? And if they have been, how have we been able to adopt them into our system in Ghana here? Thank you.
I dare say that the second question was largely, spoken to by Madame Akofa, but I'll hand it over again to her to speak to it. On the second question, and Mr. Ekwe, if you take the first question after she does that, the best practices, basically, in terms of maintaining financial stability.
Okay, thank you for that question. Yes, best practices for maintaining financial stability. We have our central bank that has spearheaded a lot of reforms in the industry, corporate governance reforms, various ratios that as banks we have to keep. Banks have to keep over 100% per the Basel III requirements, over 100% grows. So there are several ratios that as banks we keep, and that is monitored strictly by the central bank to protect the financial system. Central banks the world over collaborate and they learn from each other. We would also see that, so one thing I've realized in risk management is after every financial crisis, there are new reforms. So most of the Basel requirements have come from one financial crisis or the other. So lessons are learned, requirements are put in place that central banks monitor strictly. These days, the central bank doesn't joke at all with ensuring the stability of the financial system, and constantly they are stress testing various scenarios, writing to banks to make the necessary capital buffers available and the like. So we should be rest assured that we're learning lessons from other developed markets and implementing them here in Ghana.
Thank you. We are reassured of that. Mr. Quinn, a gentleman wants to, beat the system and know what factors he should use to consider in choosing the right banks, so he doesn't get involved in any bank loss charades in the future.
Okay, so I would say that today, what we have in terms of banks, they are all good to put your money in there and to undertake your banking needs. Of course, we have the Financial Stability Fund, which is to support banks such that should anything happen to them, the funds of depositors are available to them. Then you also have the Customer Deposit Protection Scheme or Act, which also protects your deposits. But primarily, the choice of a bank is very much dictated by you and your financial needs. Okay, so your needs would determine which of the banks you would go to, because we are all banks, we are all universal banks, but there are certain areas or certain things that we do well and certain things we don't do well. There are certain activities, if it comes to risk assets, we will support, but other banks will not support based on their risk appetite and among others. You need to look at even the products that we have. Okay, the products may look alike, but there are distinct differences between. And for you, if it addresses your need, that is the way to go. Again, locations, places. Here I'm talking both brick and mortar as in branches. I'm also looking at e-banking solutions that are available. If you find yourself in a place where the coverage, telecoms coverage is very low, then of course you realize that even though the app is available, the USSD, you have them, you cannot use them because there are challenges with the network, which is obviously not the doing of any bank. It's simply that the network is that bad, and therefore you can't do your banking on your app. You get it. So it's also very important. Again, banks are not everywhere. Some are in certain regions, certain districts, and not everywhere. Banks in Ghana are largely within the urban towns. So if you find yourself outside the urban town, chances are you will not. But that has been largely addressed by the e-banking solutions that are there. And then to some extent by our main competitor and disruptor, which is MTN, the mobile money for that matter. At least, even if you had your bank account with us and you found yourself not within the proximity of a bank, what then can you do? You can push money from your account onto your mobile money account and take the money from a vendor or an agent. So you see, we are collaborating so you can have your cash as well. I would also say we are looking at customer service as well. Customer service is a key driver in this market. So if you are looking for the best of customer service, you may look at the banks that perhaps offers it to you. If customer service is not too much, and maybe your banking needs are just basic, you may not too much be looking at customer service. You may also be looking at some financial support as well. Who is willing to support me, be it an individual or being an entity? And as I said, our risk appetites are very different. Okay, so these are some of the possible factors you look at, but the starting point, like I said, is your need. What is your need and which bank can best serve your need? After that, you can be assured that the Bank of Ghana doing what is required to do, working to its mandate, providing or giving us the support. Then, of course, backed by the Financial Stability Act Fund, and of course the Deposit Protection Scheme or insurance. Then you are good to go. So back again, it's the needs among the other things that I've said. Who addresses it best is the one to align with. And of course, you will always need a backup, because in the risk framework, there's always backup. So bank A, bank B, sometimes bank C as well. So you spread your risk accordingly as well. Each has its own strength as well. So for me, these are some of the things you should look at.
Thank you. In the spirit of competition, spread your risk, because there are more banks and we would like to have your accounts. Do we have any other questions? Okay, all right.
Ladies and gentlemen, a round of applause once again for our wonderful panelists. Thank you so very much.